I'm good.
We go live and he immediately walks away. Kevin, you there?
Yeah, I'm here.
It's good. We're just live across all of North America here, being broadcast in Madison Square Gardens, and you just decided to just up and walk away.
Hey, got to keep people on their toes.
Like the start of a bad Disney movie. Okay, Kev, great to see you. Today is a very exciting day in SMB land. We've been working for a long time on this guide, something I think that's been needed for a long time also, um, which is putting in place a guide for SMB capital raising
Yeah.
funds for SMB. Um, and we get this question all the time. How do I raise capital? Where do I go? What are the terms? What are the governance? What are the considerations? Somebody on a call this morning said, I want to raise capital. What are the pain points, Eric? And I said,
Yeah.
I'm glad you asked. Um, and
We have a
so
resource for you.
we do. Very exciting. So we've launched today what to expect when raising capital to buy an SMB. Before we dive in, though, we should do some legal disclaimers. Um, this is not legal or financial advice. Obvious securities regulation, raising capital involves heavily regulated compliance with securities laws. You want to have a good, experienced attorney to support with the capital raise. Not all attorneys are qualified or have the insurance or have the requisite experience to do this. So be very careful when selecting your attorney for a
Yeah.
capital raise. And then also that we are I don't know what this disclaimer is supposed to say. It says state that we are not liable for this is from our directly from our lawyers here. We are not liable for any outcomes based on the information shared. Okay, that's obvious. Yeah, obviously
Yeah.
results are going to vary. And I think to level set, Kevin, before we dive in, and we're just going to do a high level introduction to this resource. And then for anybody who's watching, the link to download it will be in the comments below. If you guys have any questions, also, we're watching across social media right now. So feel free to drop comments in the X, LinkedIn, or YouTube, and we're happy to address those. But before we dive in, Kevin, I'm going to put you on the spot here. What terms do you typically see in SMB and in capital raising for these types of transactions?
Yeah, it's a great question. I mean, high level, the biggest and most obvious is the economic terms. And I think we've been pretty open about what tradition, what search self-funded search economics are like. You're talking about preferred return on the invested equity. So there's some form of essentially interest rate on the capital that investors are putting in. The actual ownership, what we colloquially refer to as the step up. Um, but then the third big one is governance, and I think this is probably one that's overlooked a lot by sellers or buyers. I hear it from clients all the time. Yeah, I'm going to raise 500,000. They're going to be silent investors. Silent doesn't really mean silent when investing happens, and so there's some seat at the table that investors can and really should have when they're putting their capital into deals. And so there are going to be certain approval rights, things that the searcher or operator can't do without investor approval, because they're fundamental enough that they could, eviscerate the investors' economics. And so you're talking about things like self-interested transactions. You're talking about dilutive issuances. Bankrupting or liquidating the company, things like that, where if it could send the investors' money to zero on a fundamental decision, they generally want and should have a seat at the table. From there, I'd say the fourth big category is transfer restrictions. It's a pretty broad category, so probably beyond the scope of a quick intro. But how and when and for how much can the searcher or buyer sell the company, or can the investors, get some liquidity on their investment, et cetera. So a
Yep.
number of things to have to think through and work through when you're raising capital from third parties.
And we're going to do a webinar also in a couple of weeks. We'll send out some information on that where we're going to go deep on these terms.
Yep.
And I was leading you there, Kevin, and I asked you an unfair question. I didn't preview for those that are watching. I didn't preview that question, so I got to put Kevin on the spot. What I was looking for though is that terms vary widely, right? Very, very widely. And while we think that there is a market, so to speak, that is evolving in SMB investing in terms of economic terms, governance rights, and the like, um, you really are in a position where you can go out and get just about anything you want if you find the right investors. So what we're presenting is where we think the market is kind of generally gone and where the puts and takes are. But the reality is
Yeah.
that's still the wild, wild west of SMB investing. So I'll tick through this guide here, Kevin, really quickly, just voice over and give some thoughts. Obviously, there's some disclaimers here for you guys about who we are, our background, and over $1 billion in closed SMB transactions. Not all of those clearly did not have capital raises. I'd say probably a third of transactions right now have capital raises. Do you agree with that?
Yeah, maybe a little higher, but yeah, it's certainly not all, but I'd say maybe even as high as half. But yeah,
Yeah.
quite a bit.
Yeah, we talk in the beginning part of the guide. We really wanted to address the market and who this guide is for. It's for self-funded searchers primarily. Um, And the reality is that people, and this is a PSA I always like to make, I'm sure you see it too, Kevin, people dramatically underestimate their ability to raise capital.
Yeah.
They think, hey, I've got, I came from a lower middle class family, blah, blah, blah. I didn't invest, it wasn't an investment banker at Goldman Sachs. How could little old me go raise capital? The reality is, guys, if you find good transactions, good businesses to acquire right now, you will find investors who want to do the deal with you alongside you and have a part of it. And if you can't, that's a pretty good indication also. Kevin, are you seeing transactions that are looking for investors that aren't getting funded?
Occasionally, it's happening. It doesn't happen all the time, but it does. A lot of times, to your point, there's maybe some fundamentals on the deal. The really great, quote unquote home run. There's no home run in investing, but you get what I mean. The really great deals, generally the capital's out there. And people are willing to place the capital, but it certainly does happen. I don't want to minimize the difficulty in going and pulling together a capital raise. Usually, when I do see it fall apart, though, it's not the $4 million acquisition raising $500,000 of equity capital. It's the $12 million acquisition trying to raise 2.5 million
Yeah.
for a first time searcher. Even on a good business, it's very difficult to do. It takes a lot of work.
Well, and the reality too is a lot of those transactions shouldn't be closing, right? You're going out to smart, sophisticated investors
Yeah.
in the space, many of whom were searchers themselves and kind of know the reality of what buying a business, how tough it can be, and then they meet you and they find out about your target and they decide not to invest. That doesn't mean give up on your dreams. I'm not saying that, but it does mean that there could be something there that you yourself want to take a good hard look at.
Yeah.
So all right. So we start off, we talk about economic terms like Kevin addressed, preferred returns, step ups, ownership splits, governance terms, kind of the major elements there. The philosophy behind the self-funded search model. This is an interesting one, Kevin. Tell us why, if the SBA in most cases requires a 10% equity injection, and if I, Mr. Investor, come along and put in, you know, 90% of the equity injection that's required, why don't I own 90% of the business?
Yeah, it's a great question we get quite frequently. There are a couple of reasons. First and foremost, in the other models, everyone's getting the full benefit of leverage, and that's not necessarily true in small business acquisitions where the searcher is taking on the personal guarantee. That's probably the biggest differentiator is the investor's capital is limited to just their check. So if they're putting in, 5% of the equity, that's $100,000 or something like that, their risk is limited to $100,000. That searcher's risk is unlimited up to the entire deal value, millions of dollars on that personal guarantee. So that's probably the one biggest differentiator. Um, you know, Additionally, the idea of silent investors, no one's truly silent, maybe, but the reality is investors aren't involved in the day-to-day management. Maybe they're on a board seat and they have a conference call for an hour a couple of times a year, but by and large, the searchers, they're leaving their career and risking, not just on the personal guarantee, but in terms of work, a job. They're kind of all in the active management of the deal. Um, on the flip side, there's no operational involvement from the investors. There's no personal guarantee. They're limited to just their involvement. They get priority return of capital with a preferred return. It's almost like a quasi debt instrument. They're in a highly secured place, with the ability to get pretty solid market returns in priority, even over that searcher and potentially that searcher's family outside of a salary that they agree to take. So the risks are just fundamentally different than in the kind of non SBA area of the world and like an independent sponsor model.
Yeah, it's an interesting thing, right? Because you want to the obviously the searcher, the sponsor, the buyer, whatever however you want to characterize them to, to have the lion's share of the economics as a result of the fact that they're putting their whole life on the line.
Yeah.
The flip side is only giving you a pro rata portion as an investor of the equity injection. So if you put in, 9% of the business, should you only own 9% of the, sorry,
Yeah. Swings the
90% of the
pendulum way too far the other way.
yeah, too far the other way, right? So there's got to be that middle ground. We try to obviously you have to walk that line with SBA debt and the
Yeah.
20% cutoff for personal guarantee. So it's a fascinating model. And we dive into that much deeper in the guide. We include a couple case studies, right? We have a big transaction case study with a $10 million acquisition, and we have a small acquisition case study with a $2 million
Yep.
case study as well. So quite interesting. Preferred return broken down, the step up, which is a source of a lot of controversy in the way that it's actually described. Should be a step down. That's broken down in here as well. Governance rights, puts and takes on governance rights. We get this question all the time. I want to buy the investor out. I want to limit their ability to control me, and vice versa from the investor. And so all that's addressed in here as well. I think the final thing, Kevin, before we adjourn, and then obviously we'll include the link below for downloading the guide if you'd like it, and we'll circle back here in a week or so with a webinar that folks can get on where we'll go into this in depth. Talk about the actual securities law governance and kind of the process that folks go through to raise capital and the legal considerations involved.
Yeah, I think the biggest mistake made here is that that in some ways size of offerings are built into securities laws, but outside of being actually built into the statute, securities regulation doesn't care if you're raising $5,000 or $50 million from a compliance perspective. And I think this gets missed a lot when we talk to clients or potential clients who, it's just $100,000. Well, compliance doesn't really change all that much. And so you've got to be very careful that you're, getting good advice, good counsel, and raising this capital, taking money from investors in a way that complies with not just federal but also state laws. There's a whole concept that even I see securities lawyers missing in kind of state compliance as well. So we generally encourage our clients, unless it's like literally your dad, and we're just going to take the position that it's just a partnership from the get-go. We generally encourage full compliance with what's called Regulation D, which is a provision in the securities laws that it lays out some steps and requirements for compliance. And if you comply, your offering is effective. It's presumptively compliant with the rules to not be a public offering. The default rule, I don't want to get too in the weeds, but the default rule is if you are selling stock to a third party, it has to be registered with the SEC as a registered offering, right? An IPO. And then there's a whole series of laws that cut back on that and say there are exemptions to not do that in a private placement, selling stock privately to another person, that doesn't have to be on a public exchange. And it's the compliance to make sure that you fall into one of those exemptions that becomes supremely important, because the failure to comply with those laws, or to not have the safety net of compliance with Reg D, and kind of that presumption of being exempt, can be pretty catastrophic. In a worst case, if there's actually fraud, that can be shown criminal liability, but at a minimum, undoing investments with penalties, and things like that. So, making sure that you're taking money from people that you're allowed to take money from, making sure you're disclosing the right things to people, and ideally, again, for compliance with Reg D, making an appropriate filing with the SEC to preserve the exemption, all become extremely important, and kind of underscores the need to have people that understand, the securities apparatus, so the securities laws in the U.S. Again, that's the federal level. I'm not even scratching the surface of state level compliance on top of it. So, yeah, we'll go much more in depth on that in the webinar.
Yeah, it's hard for you to be pithy. I love it. I love being like, Kevin, only give us just a couple, yeah, 30 seconds. Tell us all about
Eric's like,
securities.
hey, in 30 seconds, summarize the Securities Exchange Act of 1933.
Tell us all of the
Okay.
puts and takes in raising capital in 30 seconds. No, we'll be back with more. But the last thing I will say, and this is like such an important point, I think, for people who are buying businesses to understand, is it dramatically changes the risk profile in your deal. You go
Hundredfold. Yeah.
from, if your deal fails post closing, that's bad, right, for you personally. But if you have investors involved too, the likelihood of litigation and legal problems just absolutely skyrockets. So really important to get this right. The guide, like I said, is available across platforms: X, LinkedIn, Instagram, YouTube. So you can grab it. It's on our website as well, smblaw.group. If you have any questions, feel free to reach out.
Thanks.
Thanks.